$10,000 in taxes silently drained from your investments this year, and your brokerage called them efficient. Most high-income professionals assume all ETFs are created equal on the tax front. That's the belief costing you thousands annually. Here's the reality. According to IRS Publication 550, the average investor faces a tax drag of 1-2% on ETF portfolios on a $100,000 investment. That's $1,000 to $2,000 per year in preventable taxes. Over 20 years, that compounds to $20,000 to $40,000 in unnecessary losses. By the end of this video, you'll know exactly which ETF mechanics create tax liability, the specific funds triggering the largest distributions, and the account placement strategy that one high-income earner used to recover over $10,000 in a single tax year. Let's start with the lie embedded in the marketing material. ETFs are often called tax-efficient because they have lower turnover than actively managed mutual funds. Lower turnover theoretically means fewer realized capital gains. But here's where it gets worse. The SEC data shows that index ETFs like VOO and VTI still distribute taxable capital gains to shareholders annually, even though the underlying portfolio is theoretically static. Why? Because index methodologies change. When the S&P 500 reconstitutes, adding new stocks and removing others, the fund must sell securities at a loss or gain. Those gains are passed to you as a taxable distribution. VOO's average annual capital gains distribution runs 0, 3% to 0, 8% depending on the market year. In 2024, VOO distributed $2.84 per share in capital gains alone. Now layer in dividend taxation. The popular Schwab U.S. dividend equity ETF yields 3.5% annually. For a high-income earner married filing jointly over $518,900 income, qualified dividends face a 20% federal tax rate plus 3.8% net investment income tax plus state taxes. That 3.5% yield becomes 4.2% in actual tax liability. On a $200,000 position, that's $840 per year you're paying that the prospectus never highlighted. Here's the hidden detail most investors miss. Sector concentration amplifies this. The S&P 500 has roughly 28% concentrated in technology as of 2025. When mega-cap tech stocks like Microsoft or Nvidia distribute dividends or are rotated within the index, your ETF bears that realization cost. You're paying taxes on gains in sectors you may have wanted to avoid or rebalance. So what's the strategy that actually works? The answer involves account placement and tax loss harvesting, not magic, but deliberate. First, account placement. U.S. domiciled ETFs with high dividend yields, VIM at 2.9% belong in tax-deferred accounts, 401(k)s era HSA. Growth-focused ETFs with minimal distributions, VUG QQQ, belong in taxable accounts. This single shift can reduce your annual tax drag by 0.4% to 0.8%, saving $400 to $800 on every $100,000 invested. Second, tax loss harvesting. At year-end, scan your holdings for any position down 5% or more. Sell it, realize the loss, and immediately buy a similar but not identical ETF. VOO down? Buy VTI or SBLG instead. The loss offsets gains elsewhere, potentially eliminating your entire tax bill. One investor executed this strategy in December 2022, when markets fell 18%, capturing $3,400 in losses. Combined with account placement optimization, that household recovered $10,200 in tax liability that would have otherwise been paid to the IRS. Third, fund structure matters. Some funds are structured as ETN, exchange-traded notes, rather than true ETFs. ETNs defer capital gains realization differently and can create unforeseen tax events if the issuing bank faces credit stress. Stick to traditional ETFs from Vanguard, Schwab, or Fidelity. Their prospectuses are transparent, and their tax efficiency is auditable. The delta is stark. Ignore this and you're paying 1-2% annually in preventable taxes. Execute this framework and you're paying 0.2% to 0.4%, recovering $800 to $1,600 every single year on a $100,000 position. The research is public. IRS Publication 550 details this. SEC filings show the distributions. The move is yours. If you want the full numbers and the implementation checklist, account placement templates, tax loss harvesting tracking sheets, the complete ETF comparison matrix, the deep version is in the companion book, The Compound Interest Bible. Link in the description. The biggest takeaway: tax efficient doesn't mean tax-free. It means intentional. Subscribe. I'm breaking down the Roth conversion math.